Ya, Bismillahirrahmanirrahim. Alhamdulillah, Allahumma salli ala Sayyidina Muhammad wa ala alihi wa ashabihi ajma'in amma ba'd. So today we are going to learn about bond valuations. Uh, so in the last class, we have learned about what is bond, and what are the types of bonds, and what are the things that may affect the price bonds and the price performance and etc. We also learn about the many characteristic of bonds in compare to stocks. So by this class, I think that you guys have already know the difference between bonds and stocks. Yeah. Okay. So for today, we are going to learn about some calculation on bonds and how we evaluate the bonds, how we price the bond, so that we have an idea if whether a bond is mispriced or it is at the right price or it is overpriced. Yeah. So by doing this calculation, hopefully it will give you an idea of the bonds valuations. Okay. So first of all, I will start with the basic formula for calculating or for evaluating the bond. So here we have that the required return for the bonds is the R star plus IP plus RP. Yeah. So here the R star is the the R star here is the required rate of return that we wish to get from investing in bond. The RP here is the risk premium, yeah, and the IP here is the, I think this is the price, yeah, the price that we get from investing in bond. Yeah, so we will get later on this, and let me just explain the the several preparations, yeah, before we start calculating. So here it said that for bonds, the risk premium addresses the default risk, yeah, of the issuer, liquidity, and call risk. So the risk premium that we have here, it represents all the risks available for the bond. We remember last class we learned about several risks that may expose to the bond. So here it says that the risk premium that we have in this formula represent all the risks associated to certain bonds. Yeah, the risk-free rate, yeah, real rate of return plus expected inflation premium accounts for interest rate and purchasing power risk. Yeah, so keeping tabs on market interest rate, what cause rate to move, the term structure of interest rate and yield curve. So and then we have here the risk-free rate. Yeah, the risk-free rate is it is sometimes it is some of the rate that are different from the risk premium. The risk premium is the additional rate of expectation that we expect to get in the future. But when we say the risk-free rate, it is sometimes it is some of the rate in the market that we use to evaluate the bond or to evaluate some investment. Okay, so let me continue. Yeah, the bond market is not a single market, but it also consists of many different sectors. For example, U.S. Treasury issue, municipal bond, corporate bond. So when we say a market of bond, yeah, we are usually dealing with many bond products or many issuer of product. So we have the U.S. Treasury. We have also the bonds that are issued by the municipal governments. And also we have bond issued by corporates. Yeah. There is no single interest rate that applies to all the segment of the bond rates. So because we have different types of bonds which have different types of segmentations, there is no single interest rate that we can use to evaluate all of the bonds available in the market. In that case, we will use what we call the yield spread. Yeah. So what is the yield spread? The yield spread is the difference in interest rate between the various market sectors. So we will use the yields, yeah, which is the difference between the interest rate of different markets. Instead of using a single interest rate for all evaluation of bonds, we will use the yields. So the yield is the difference of interest rate, yeah, between various market sector. Okay. So here say that municipal bonds are usually 20 to 30% lower than the corporate bond due to their tax exempt feature. Yeah. Say that the yield, yeah, the interest rate on municipal bond which are issued by the municipal government, usually they are lower than those issued by corporations. Why? Because those bonds issued by the municipal governments, they usually have a feature which give you a free tax. We call this tax exempt feature. So you don't need to pay, yeah. So you don't need to pay tax while you are buying the municipal bonds. But it is different in corporate bonds when you have to pay tax. Yeah. So usually, yeah, the yield of municipal bond will be lower 20 to 30% than corporate bonds because of this feature. Yeah. Okay. The general obligation bond pay lower rates than revenue bonds. Yeah. So here we have the revenue bonds, and it is usually, yeah, pay higher interest rate than the general obligation bond. All right. And treasury bond have lower rates than corporate bonds due to no default risk and exemption from state income tax. Yeah. So remember, we have the corporate bonds. Usually they have some kind of a default risk to remember, to consider. Yeah. And with this default risk, yeah, usually corporate bonds will be giving you higher interest rate than those issued by the governments. Okay. Right. Okay, next, bond with longer maturities generally provide higher yields than short-term issues. Yeah, but this is not always the case. But usually when the bond have a longer maturity, it also possess higher risk. Yeah, so that's why,
Sir,
yes.
sorry. You're not showing the screen share.
Oh, okay, okay, okay. Okay, I will try to fix this. Yeah. Right. So I think I have. Okay. Now I'll try to go back to my Zoom. Okay. All right. So let me continue. Yeah. So usually bond with longer maturities, yeah, they will have higher yield, higher interest rate. They will giving you higher coupon. Yeah, why? Because the longer the maturity, the higher the risk it possesses. So that's why when you have a different in maturities, you see that bonds with longer maturities, yeah, they will always have higher yields. Last but not least, freely callable bonds generally pay higher interest rates than non-callable bonds because of the feature callable bonds. When the company can, repay all the debt, yeah, before its maturity, because of this feature, they will provide you with higher yield, higher interest rate, higher coupon. Yeah, that's why uh, it is not always beneficial for the investors to invest in such bond. That's why they will require higher yield. Yeah. Okay, next we have the determinants of interest rate. Yeah. So one of the factors that affect interest rate is inflation. So here is said that when inflation is expected to goes up, the interest rate goes up. Yeah. But when the inflation is expected to goes down, the interest rate also go down. Yeah. So why do we have to look for inflation before investing in bond? Because bond are strongly related to interest rate, to the market interest rate. Yeah. When you want to invest in bond, you'll see the interest rate, right? And you'll try to evaluate the price of that bond based on the market interest rate. And one of the factors that influence the interest rate is inflations. So that's why you need to keep monitoring the inflation, so that when the inflation is expected to goes up or down, you will see that the interest rate are going to be increased or decreased. And so that when the interest rate has decreased or increased, then you will try to reevaluate your bond evaluation, your bond pricing. That's so that you will have, so that you can buy the bond in its fair price. Okay. In addition to the inflation, we have five other economic variables that can significantly affect the level of interest rate. Yeah. So, for example, so this is the graph that shows you the relationship and the trends between inflation rate and the interest rate. See that the blue line is the inflation and the red line is the interest rate. And we see that if the inflation is expected to increase, yeah, the interest rate is also expected to increase. But when we have an expectation of a decrease in inflation, the interest rate is going to decrease. Yeah. And if we can see here, yeah, the trend is almost the same. Yeah. So the inflation will will always affect the market interest rate. These are the other determinants of interest rate. We have the change in money supply, the federal budget, and US, the economic activity. Yeah. So if we see a change in money supply in the market, yeah, we will have an effect on the interest rate. Yeah. So these are the effect of interest rate based on the change in economic variable. Yeah. So for example, here we say that we have a deficit federal budget, or a surplus federal budget will affect, will lead to an increase in interest rate and to decrease in interest rate. Yeah. For example, if we have recessions, yeah, the interest rate will decrease. But if we have an economic expansion, we are expecting that the interest rate will increase. Yeah. So these are the things that will affect the interest rate, and uh, we need to keep monitoring on these variables, so that when we want to invest in bond, we can expect what the interest market, what will the interest market level at, and then by considering the market interest rate, we can buy or we can invest bond at its fair value. Another variable here, for example, the Federal Reserve policy. Yeah, this is related to monetary policy. If we have an expansionary monetary policy, we are expecting that the market interest rate will decrease. But in opposite, yeah, we have a contractionary monetary policy, yeah, then we are expecting that the market interest rate will decrease. Yeah. Last economic variable that we have here is the foreign interest rate. Yeah. So if we have an expected increase in foreign interest rate, yeah, our local interest rate, our market interest rate will also decrease. But if we have an expectation of a decrease in foreign interest rate, then our market will follow. Yeah. In that case, that the market interest rate, our local market interest rate, will also have an expectation of decrease. Okay. Right. So this. Now we will learn about the term structure of interest rate. So basically, it is a graph. Yeah. So this graph is what we call the term structure of interest rate. So what is it? Is it the relationship between interest rate, the yield of the market, and the time to maturity for any class of similar risk securities? So we will see the relationship between yield to maturity. Yeah, yield means the interest rate that we are expecting to receive, and the term to maturity is how long that our bond will reach to its maturity, to its repayment date. Yeah. So we have what we call yield curve. So yield curve is a graph that depicts this relationship. Yeah. So again, yeah, this is the term structure of interest rate, which shows you the relationship between yield to maturity, the interest rate that we are expecting to receive in the future, with its maturity. So the longer the maturity here, we have two kind of graphs. Yeah. One graph is upward sloping and another graph is downward sloping. Later on, we will learn when this yield curve will have an upward sloping trend and when this yield curve will have a downward sloping trend. Yeah, we will learn about this in the next slides. Okay. So these are the characteristics of the yield curve. The most common type is the upward sloping. Yeah. Occasionally, the yield curve becomes inverted. It is just in occasion. In some occasion, it becomes inverted. So it becomes downward sloping. Yeah. Downward sloping. The yield curve also can be in a flat shape. And when does this happen? When we have a short and long-term debt are essentially that's the same. When we have a rates for the short and long-term debt, which are essentially the same. So when we have a rates for the short term and a rates for the long-term debt, they have a similar interest rate. We will see that the yield curve is going on a flat shape. And the last shape we have is hump shape. So this is when intermediate rates are the highest. So when we have bonds with intermediate maturity, yeah, and the rates are the highest compared to the short term and to the long term bond maturities, yeah. So we will see a humped shape. Hump shapes probably like this. Okay. right? So yeah, so okay, so let's try to understand here this. So the treasury securities, bills, notes, bonds are usually used to construct yield curves for several reasons. Yeah. First, so we use bills, notes, and bonds in order to graph this curve. Yeah. But we have two kind of curves, right? The downward sloping, yeah, and the upward sloping. Yeah. There are some variables that will affect the shape, but let's try to understand how this shape is built. Okay. So treasury securities such as bills, notes, and bonds are usually used to construct this yield curve. And there are several reasons why these securities are used. Yeah, for example, the treasury securities have no risk of default because it is issued by the government. They have a very low risk of default. Yeah, they are also actively traded, yeah, in the market because they are owned by the government. They are very uh, actively traded. Yeah, relatively homogeneous with regard to the quality and other issue characteristic is almost the same. Yeah, between bills, notes, and bonds. What the difference is that the maturity, yeah, the maturity and some of the feature maybe. But if we see the issuer, yeah, they all issued by the governments. Yeah, so we don't see big differences between the securities. Okay. So the yield also can be constructed with other classes of debt security, such as A-rated municipal bond or AA rated corporate bonds, or even certificates of deposit. Yeah. So this yield, yeah, the difference in market interest rate can also be constructed with other high quality instruments. Yeah. For example, A-rated municipal bond or AA rated corporate bonds. Yeah, so this is how it looks like, and these two curves are coming from the data from this. Yeah, so for example, this is the date of maturity. Yeah, and here we have uh, the 30 years. This is the maturity. Yeah, the maturity of the securities. Yeah, and if we see here is that, yeah, we have two kind of trend, which is a downward trend and upward trend. Yeah, we will learn about why these yield curve have two different shape. Yeah, so there are some theories to explain why the yields have a different trends of upward and downward. So we have what we call expectation hypothesis, the liquidity preference theory, and the market segmentation theory. So these three theories will explain, yeah, whether yield curve will have a positive trend or a downward trend. Expectation hypothesis. This is the first theory to explain the trend in the yield curve. Yeah. So according to expectation hypothesis, the yield curve reflect investor expectation about future interest rate. So when investor expect interest rate to go up, they will only purchase long-term bonds. If those bonds offer higher yield than short-term bonds, hence the yield curve will be upward sloping. So because the investor uh, have an expectation of an increase in interest rate in the future, they will usually go to buy the long-term securities. And when these long-term securities have higher yield, provide higher yield, the demand on long-term securities will be increased. So that's the yield curve will goes up. However, when the interest rate go down or is expected to decrease, yeah, investor will only buy short-term bonds. Yeah. And usually when we have an expected increase, an expected decrease on interest rate, yeah, the short-term bonds will be more valuable. Yeah, they will provide higher yield than the long-term bonds. That's why the demand on short-term securities will be high, and you'll see that the yield curve will go down or will have a downward sloping. Okay, this is the first theory. The second theory to explain the shape of the yield curve is the liquidity preference theory. So according to this theory, yeah, long-term bond rate should be higher than short-term rates because of the risks involved with longer maturities. Yeah. So investor may view long-term bonds are being riskier because long-term bonds are less liquid and are subject to greater rate risk. Yeah. So the borrower will also pay a premium to obtain long-term funds. So usually when we have an investor that needs some fund in a very long future, yeah, they will go to buy bond with longer maturities and they will be happy to pay premium on it. Yeah. So the borrower does assure themselves that funds will be available and avoid having to roll over short-term debt at unknown and possibly unfavorable rate. Yeah. So according to liquidity preference theory, those security with long-term maturities usually have higher risk. That's why they will be giving you higher yield. Yeah. So because the higher yield incorporates with the long-term securities, the yield curve will have an increased trend. Yeah. The last theory to explain why the yield curve has both upward and downward slopes is that we can explain it by the market segmentation theory. So the bond market is segmented on the basis of the maturity preferences of different investors. So the yield curve change as the supply and demand for funds within each maturity segment determines its prevailing interest rate. Yeah. So if supply is greater than demand for short-term loans, the short-term rates will be relatively low. If at the same time demand for long-term loans is higher than the available supply of fund, the long-term rates will move up, the yield curve will slope upwards. Okay, so it means that the market segment theory, market segmentation theory describes about the relationship between the interest rate and the maturity of each securities. It says that if a demand of such securities increases, yeah, the interest rate will also increase it because the interest rate is the price of that securities. Yeah. So if the supply is greater than the demand, yeah, the yield on that securities will be decreased. But if the demand for such securities increase, the yield on that securities will increase because yield represent the price of that instruments. So if we have an increase or decrease in supply and demand, it will reflect to the yields. And based on the yields, investor will look and buy such securities where the yield is high so that they can have higher profits. Okay. So these are the summary for such three theories. So we have upward sloping yield. This is due to the expectation of rising interest rate. Yeah, the lender preferences for short-term maturity loans and greater supply of short-term loans. Yeah. But we have a downward sloping yield because of the expectation of a decrease in interest rate, yeah, the preference of for longer maturity loans, and a greater supply of longer term loans. So these activities will affect the yield of the markets, the difference interest rate in the market. Yeah, right. So why do we have to analyze the yield curve? It provides investor with information about future interest rate movement, which affect the prices and return of different types of bond. Okay. So for example, if the entire yield curve begins to move up, yeah, indicating inflation is going to be increased, yeah, then investor expect interest rate too will rise. Yeah, seasoned bond investor would turn to short intermediate maturities. Yeah. So if they see that the market yield curve is going up, meaning that the inflation is also going up. When the inflation is going up, the market interest rate will also goes up. Yeah. And when this happen, yeah, investor will go for short to intermediate bonds. Yeah. Because they will see more profit investing in short or intermediate maturities bond. Okay. So this is the benefit on analyzing the market yield. Yeah. So to use the trend in the yield curve to provide with information in future interest rate movement, future inflations, future yield. Yeah. So that they have a very good decision making on how to invest in bonds with certain maturity. So if they are seeing that the interest rate goes up, they will just buy short or intermediate bonds. But if they are expecting that the interest rate will goes down in the near future, yeah, they will try to look for longer maturities. Yeah, longer maturities. So a steep yield curve are generally viewed as a bullish sign. Yeah. So aggressive bond investor would look to move into long-term securities, while flatter yield curve reduce the incentive for moving to long-term maturities because the difference in yield between different maturities is very small. So if we have a very steep increase or a decrease, yeah, will make our investor, yeah, move or invest aggressively because they see a very huge incentive in investing in bond with different maturities. Okay. Now we will learn about pricing. Yeah, how we price the bond. So we have four simple model to price the bond. Yeah, and we have several variable that we need in order to price the bond. So basically, the basic idea of bond valuation model or pricing is that we take the present value of all the cash flow that we will receive, and also we take the present value of the face value that we will receive in the maturity. So we take all of the coupon payment and the face value payment at maturity, and we take them at their present value. Yeah. So if we can calculate the present value of all the coupon that we will receive and the face value that we receive at maturity, then we will have the price of the bond. So this is the basic idea of bond pricing. Yeah. Uh, Annual compounding. First, yeah, we will learn about the bond with annual coupon rate. Yeah, for example, yeah, so the annual coupon payment. So bond will give you a certain coupon payment with par value of 1,000. So we will take this 1,000 to its present value, and we will have the number of years remaining to maturity is n, and prevailing market yield to use as the discount rate. So this is the yield, market yield, yeah, market yield that we will use as the discount rate to get our present value estimation. Yeah, so basically the basic idea on pricing the bond is that we take the present value of all the coupon that we will receive, and we also take the present value of the par value of the face value at maturity. Yeah, so this is the basic formula. And next, let's try to calculate it. So in this case, I'll just try to open my Excel, yeah. So here I will try to open my Excel. Okay, so yeah, I have my Excel on my right side, and I have the PowerPoint on my left side. So for example, here we have a bond. Yeah, the face value is 1,000 US dollar. Yeah, and the maturity is 20 year, 20 year. So the maturity is 20 year. It gives you a coupon of 4.5%. So just use 4.5% here. And the market yield, yeah, the market yield is 5%. So let's put here. Yeah. So this is the face value. Yeah. So all right. So let me continue here. So the basic idea is that we have to take the present value of all coupon payments, plus we will take the present value of the face value at maturity. Okay. So if we have an Excel, or if we have a financial calculator, we'll just use some functions. So in this case, yeah, we will go to here. Yeah. So there is a tab called formula. Yeah. This is the tab that have a function here. Yes, and in this function, we will go to present value. Yeah, present value, PV, present value. Now this one, present value. Yeah, and now we will have this a small box that we have here. Yeah, and I will try to input, yeah, some of the data that we have here. First, yeah, rate. So the rate here is the interest rate, the market interest rate is the yield. So we will put 5% here, yeah. And number of payment period here is the maturity. So we will choose 20 years here as the number of payment. So, and then we have payment. Payment is the coupon rate. Coupon rate. So we have 4.5% of the coupon rate. Yeah. So this is the payment value. So we need to take the 4.5% from 1,000 US dollar from the face value. So here we have 45. Okay. And then we have the future value. The future value is the value that we will receive in the future, the face value of the bond. So we will put here 1,000. Yeah. Okay. Now we will have the present value of all of this calculation. Here it said that minus 937.6 US dollar. So this is the current bond price, yeah, that we evaluate. This is the current bond price that we estimate, and this is the price that we buy that bond. So if you have a bond giving you the face value of 1,000 US dollar, and it will mature in 20 years, and it will give you a coupon of 4.5%, while the market yield is 5%, yeah, you see that the price of that bond is 937.7 US dollar. Okay. All right. So this is the bond price. The easiest way is that if the coupon rate, if the coupon rate is giving you less than the market rate, we will buy that bond at a discount price. You remember the last class? Yeah. In the last class, we tried to predict, in a simple way, whether we have to buy a bond at the discount or at the premium price. Yeah. So if we have a discount price, is that when our coupon is giving you less than the market yield, than the market interest rate, we will buy that bond at the discount rate. So this is the fair value of that bond. So you will buy this kind of bond, or the bond with this characteristic, at 937.7 US dollar. Okay. Do we have any question here? If you put okay, this is the price that you will buy at. Do we have any questions? Yeah. Okay. Let's now go. Yeah. When the bond is giving you semi-annual coupon. Yeah. Remember last time I said that the coupon rate could be paid in annual manner, and it could also be paid in semi-annual manner. So it means that you will receive the coupon payment twice in a year. So when we have a case of semi-annual coupon payment, which are the most commonly used method of paying the coupon payment, so the calculation will be different. So when we have semi-annual, we need to make some adjustment. The adjustment that we will make will be at the maturity. So this is the adjustment that we need to make at the coupon payment and at the market yield. So what will happen is that we will so in this case 4.5, so this is 45, 45. 45, wait, let number, this is not percentage. 45, okay. All right. So what happened is that when we have a semi-annual, we need to multiply each of this number by 2. Yeah, so we will multiply maturity by 2. Yeah, and also we will, yeah, for the coupon rate, we will divide the coupon rate by 2. Yeah. This will be divided by 2. And for the market yield, we will divide it also by 2. So it means that we have higher, or we have uh, more payment of coupon, because now the coupon is paid twice a year. So meaning that we have uh, more payment of the coupon. So in this case, the coupon payment will be twice. Yeah. So let me change this number, yeah, to general. Okay. No. Okay. So this is the adjustment that we will need to make. So this is annual coupon, yeah, annual coupon, and this is semi-annual coupon. Okay, so in case if we have a semi-annual coupon, we will need to make some adjustment. The maturity will be longer. Yeah, it will be 40, because we are having a coupon payment twice a year. So the maturity, or the payment maturity, will be double. Yeah, and the coupon, before we receive $45 each payment each year, now we will receive $22.5 in every 6 months, in every semester. And the market yield, because we are taking the present value for every semester, then we need to divide the market yield by 2. So this is the interest rate on semester basis. Yeah. And we will do the same. So we'll take the present value. So simply go to formula, then we insert the function, and we go to the present value, because we want to calculate the price of this bond. Yeah. The rate is 0.025. The maturity is 40. The payment is $22.5. Yeah. And the future value, the same. Yeah, 1,000. Now, this is the price of the bond. Yeah. That this is the price of that bond that we can buy. This is the price that we buy at. Yeah, it's 937.2430, yeah, US dollar. Okay, let's try to differentiate. Let's try to compare between these two prices. You see here that bond with longer maturity have higher price than bond with shorter maturity. See here, there is a little different. Yeah, let me take the difference. So the difference is 0.4459 US dollar. Yeah, where if we pay, yeah, the bond with annual coupon payment, will have a higher price than this bond paying us at semi-annual coupon payment. Okay. Right. So do we have any questions in regard to this bond valuation? Is it clear, guys? Okay. Remember here, yeah. So the present value will always be negative. Yeah. It doesn't mean that we are paying a negative price, but it's just how the calculation work. So they will give you a negative value, but you'll take the absolute value of this negative, and it will give you the price that you should pay at. Okay, so this is the semi-annual compounding uh, bond. We also have accrued interest. Yeah. So what does it mean? Accrued interest is the amount of interest earned on a bond since the last coupon payment. Yeah. So the bond buyer adds accrued interest to the bond's price. So when sometimes, yeah, when you buy a bond, you may buy a bond with the accrued interest. So this is the last time interest payment that they give, the coupon will be added to the price. Yeah. So the price of the bond will be higher. So here we have two kind of prices, clean price and dirty price. So clean price if the bond equal to the present value of its cash flow, while the dirty price means that the bond is the clean price plus accrued interest. Yeah. So sometimes you buy bond at accrued is at a dirty price, meaning that they will try to add the interest payment they received last time to the bond price. So this is what we call the dirty price. Uh, okay. So that was the calculation of the bond price. Next, we are going to calculate the yield. Yeah. The yield is the return. Yeah. So when we measure the bonds yield, we are usually measuring the return. Yeah. So for example, uh, okay. So now we will learn about the bonds yield. So what is the bonds yield? Bonds yield means the performance of that bond. Yeah. So there, when we try to calculate the yield, it means that we are trying to assess the return on a bond. Yeah. So there are yeah, several approaches that we can use to assess the return on such bond. We have a current yield, yield to maturity, yield to call, expected return, and then bond valuations. So let's just go to the first assessment, bond assessment. So the first bond assessment is the current yield. Yeah. So the current yield indicates the amount of current income a bond provides relative to its prevailing market price. So the current yield is the interest income that we receive divided by the current price of the bond. Uh, it is the simplest of all bond return measure. So usually we take the higher current yield. So if we have a different bonds with different maturities, different issuer, different characteristic, yeah, this is the simple assessment that we can have. So we take the current yield. So this is the annual interest income, the annual coupon divided by the current market price. And then if we have several bond, we will choose the bond that have highest current yield. Okay. Okay. Next, we have yield to maturity. Yeah. Next, we have yield to maturity. Yield to maturity is the most important and widely used measure of a bond's returns. So this is the widely used method to assess the return. Yeah, it is also known as the promise yield. So the rate of return earned by an investor who hold a bond to maturity and receive all principal and interest payment when promised. So the yield to maturity, actually the return that we will receive after investing or buying such bond, with an assumptions that we will hold this bond until maturity. We will not sell this bond before the maturity. We will hold it. We will receive all the coupon payment, and we will receive also the face value at maturity. Yeah. It used not only to gauge the return on a single issue, but also to measure the required return for broad classes on bonds, basically the internal rate of return on a bond. So it is used also to compare and to assess, yeah, many bonds. So usually the bond with higher yield to maturity is more interesting. Yeah, it will attract, yeah, the attention of investors. Okay. So now we will learn about how to calculate the yield to maturity. Yeah. So we can use the function in Excel to help us. Let's try to look for the example. Yeah. For example, we find the yield to maturity on a 7.5, meaning that this bond is giving you a coupon on 7.5% with a par value 1,000 and 50 years to maturity, and is currently trading in the market at 809.50. So we will just put the data here. So first, yeah, the coupon, they give you coupon of 7.5%, meaning 75 US dollar. The face value or the future value is 1,000. The maturity, yeah, maturity is 15 years. What else? And the current price, yeah, the current price. Yeah. So the current price is 809.5 US dollar. Yeah. So these are the data that we have. Uh, and then we will calculate the yield to maturity or the expected return on that bond. So simply go to the tab formula, and then we have a function here. Yeah. Uh, go to financial and go to rate. Yeah, rate. This is the rate. Okay, rate. All right. So we have several things that we need to input. Yeah. First, NPER. NPER means uh, the the number of period. Yeah. So this is the maturity. So before we before we input the data, we need to make sure whether this bond is paying you at annual or at semi-annual. So after reading, we didn't find any statement which state that the bond is paying you at semi-annual. So in this case, we can assume that this bond is paying you at annual coupon payment. So we'll just put the data. Yeah. So NPER is the number of period. We'll put the maturity 15 years. The coupon payment here we have a 7.5% from 1,000 US dollar, which is 75 US dollar. and the present value, the current price. Remember, yeah, the current price is 809.5. But in this case, we need to have a negative sign. Yeah, we need to have a negative sign. Yeah, and then the future value or the face value that we will receive in the future is 1,000. Okay. All right. So here, in this case, we have 0.100053387, or we can call it 10%. So we say that the yield to maturity for this kind of bond is 10%, meaning that if you invest in this bond, you buy now with 809.5 US dollar, and you keep this bond, you receive all of the coupon payments. You will not sell this bond until maturity, until you receive the face value of the bond. Yeah, we will have a required rate of return of 10%. Yeah, so this is the required rate of investment. So this is the rate of return that you will receive investing in this bond. 10%. Yeah, it's quite high actually, because if you invest in stock, yeah, maybe you will lose, but it takes 15 years to get this 10%. Yeah, so we need to be very careful. We need to be very consider, yeah, investing in this kind of bond. Right? Okay. Next we have a semi-annual bond. Yeah, if we have a semi-annual bond, what you do, you need to have some adjustment. Yeah, and this adjustment is in the coupon, maturity, yeah, and in the coupon and in the maturity. All right. So let's try to, because we're receiving it at semi-annual manner, meaning that in each year you will receive as twice coupon payment. Yeah, so we need to make some adjustment. So the first adjustment is on coupon. Yeah, so we will receive coupon semi-annually. Yeah, like this. Yeah, so we will receive semi-annually, and the future value is the same. The maturity will be longer. Yeah, because we receive the coupon payment, yeah, at semi-annual, so the maturity will be longer. Yeah, so these are the two variables that we need to make some adjustment. All right, so now we will learn, or we will try to calculate the yield to maturity. So what we do here is that we go to the formula, go to the functions, and choose the financial functions, go to rate. Yeah, rate. Here we have rate. Yeah. So we have a number of period is 30, payment 37.5, the present value. Remember, the present value, the current market price should be in negative value. So you put negative sign here. Yeah. And then the face value is 1,000. Right? Okay, now you click OK here, and then you will notice that the yield to maturity is wait a second. You see that the yield to maturity is 4.99. 4.99. Yeah, 4.99. All right. Okay, so this is the yield to maturity for semi-annual bond. So if you want to get the yield to maturity for the annual period, then you just multiply this by 2, and then you will have the yield to maturity for the annual manner. for the annual manner. Okay. Okay, so we have the quite different here. Yeah. So this is the annual coupon payment, the semi-annual. Yeah. Uh, so if we invest, yeah, our investment in a semi-annual manner, longer period, yeah. So we will get around 4.99%. Yeah. So this is the yield to maturity for semi-annual coupon payment. Yeah. Okay. So is there any questions for calculating the yield to maturity? So we have yield to maturity for annual coupon payment and semi-annual yield, yeah, for semi-annual kind of bond. Yeah. So this is the bond that pays you twice a year. Okay. Is there any question?
So far,
Okay. Thank you, Mas Sultan. Yeah. So I will also upload the Excel, yeah, in my ETS classroom so that you can learn how we get this calculation. Okay. Okay, next we'll learn about the finding the yield on a zero coupon bond. Yeah, so a bond which give you zero coupon it will not give you any coupon payment, but it will directly give you the coupon payment at the end with the face value. Yeah, so basically this kind of zero coupon payment is a bond that is selling at discount rate. Yeah, for example, yeah, so we have this kind of situation where we have a 15-year zero coupon bond that are selling for $315. So it will be very, very discount. So we'll buy at the discount rate. Yeah. Uh, so what do we do and how we calculate the yield to maturity for this kind of coupon payment or zero coupon payment is we use this formula. Okay, so please remember this formula because uh, in the Excel it will not give you uh, the calculation for zero coupon payment. Yeah, so the yield equal 1,000 divided by the price, and to the power of 1 over n minus 1. Yeah, so simply by doing this, yeah, 1,000 divided by the price that we are buying this bond for, which is at a discount price of 315 US dollar, yeah, to the power of 1 over 15. 15 is the number of year minus 1 will give us 8. So this is the 8%. Yeah, 8%. 8% means that if we buy a zero coupon bond at discount price, which is 315 US dollar, and we keep this bond until maturity, we will have a return of 8%. Okay. Another case is that we have a semi-annual. So when we have a semi-annual, yeah, we will receive the year 15 with 30, yeah, to find the yield. So the yield will be 3.926% per half year, and the bond equivalent yield to be 2 multiplied by this yield equals 7.85%. Yeah. So the above example is the calculation if we assume that the interest rate or the coupon payment will be paid annually, but the below simulation or example here is that a case where the bond is paying at semi-annual. But of course, this is a zero coupon bond, right? So we don't have a coupon payment here. We're just assuming that the coupon are paid annually and semi-annually based on the average of bonds that are available in the market. Yeah. So this is just an assumption. Okay. Next, we have the yield to call. Yeah. So the yield to call, remember, a bond with a call feature means that the issuer can repay all the face value and some profit from us for us, yeah, in order to have an early payment of the face value. So they will pay the face value before its maturity. So this is the feature, this feature called callable bond or callable feature. Yeah. So how to calculate, yeah, the bond when they have the feature of callable. Yeah. For example, find yield to call on a 20-year bond. This is the maturity of the bond. 10.5% deferred call bond that is trading for 1,204 US dollars. So they're selling at premium, but can be called in 5 years at a call price 1,085. So this bond can be called in 5 years. So the issuer can repay back the face value in 5 years at a call price of 1,085 US dollar. Yeah. So uh, so we need to find, yeah, the yield to call. Yeah. So we need to find the yield to call. Yeah. Simply, yeah. So simply we will use, yeah, this calculation. Yeah. Simply, so the yield to call will be 7. Yeah. So if we try to uh, calculate, yeah, this bond, so this is the model that we can, yeah, to calculate here. So here it said that uh, the bond, yeah, the bond will have a yield to call of 7%, but the yield to maturity is 8.37%. So yield to maturity is the case where the company decided not to call the bond after 5 years. So meaning that the yield to maturity is you will hold after until 20 year, you will receive all the coupon payment. Yeah, you will receive all the coupon payment and you will receive the face value at maturity. Yeah. So we see here that the yield to maturity is higher than the yield to call, meaning that the yield to call is less preferable for customer, for investor, because they will receive less profit. Yeah. Before they are expected to receive 8.37, but now because of the call feature, they will receive only 7%. Yeah. So it's simple. We can calculate the yield to call by the same function that we calculate the yield to maturity. But remember, the maturity is only for 5 years because they have the call feature in year 5. Yeah, and the face value will be 1085, while at yield to maturity we keep the face value at 1000. All right, so do you understand the difference between yield to call, or should I make a simulation on this calculation yield to call?
Can you show the simulation, sir?
Okay, so thank you, Mas Sultan. Yeah, so I will give some simple simulation for this kind of question. Yeah, okay. So callable bond. First, what is the face value? The face value, not call. Okay. What is the face value? Here is 1000. But when they use this feature, the face value will be 1085. Yeah. Not call means that they will keep holding it until 20 years. Okay. But when they call it, they will, this is only 5. So maturity, this is 20, this is 5. Yeah. Uh, then the current price is 1204, which is also the same here. And market, yeah. Okay, so these are the data that we have. Yeah. So first, let us calculate the yield to maturity. Okay. Uh, okay. So this one. Wait. Okay. So first, let us calculate the yield to maturity for this bond, assuming that they are not conducting or they are not taking their callable feature. Yeah. Go to formula, insert function, choose financial. Yeah. And then we go and choose rate. Where is rate? Rate, rate. Nah, this one. Yeah, rate. Okay. Now the maturity is 20 year, right? The coupon payment. Yeah, coupon payment. Oh, we forgot to to mention the coupon payment. Coupon payment is 105 US dollar. Okay. So let us calculate it again. Financial, and then go to rate. Yeah. Where is rate? Yeah, this one. This one is rate. Okay. So now we have this N per means number of periods, which is 20 years. The payment is 105. The present value is how much we buy for, current price. Remember to put negative sign. And the future value is 1000. Yeah. When you click OK, yeah, you'll have yield to maturity. Yeah, yield to maturity. So the yield to maturity is 8.37%. Now let's try to assume that this bond, yeah, this bond is calling at 5 years. So they will not exercise the face value at maturity. They will not pay you back at maturity, but um, they will make it faster. They will they will call the bond at 5 year, in 5 year. So let's try to calculate the yield to call. So this one is different than the yield to maturity. Yield to maturity, we have an assumption that we are going to hold this bond until maturity. We receive all the coupon payment and the face value at maturity. But at at this call function or call rights, yeah, we will only hold it for 5 years. Yeah, because the company will repay back the loan or the debt at after 5 year, and they will give us kind of kind of a little profit for compensation. Yeah, so the callable price will be at 1085 US dollar. So we go to function, choose the financial, go to rate. Yeah. Nah, okay. So we put the data, and per means the maturity, only 5 years. The payment is the same, coupon payment. The present value is the negative of current price, and the face value or the future value is $1085. So this is the callable price, we call this. Now we click OK. And then we will get how much? 7% of yield. So our expected return actually higher when when the company does not exercise its callable function. Yeah. Because what? Because the call to yield is 7%, while the call to maturity, when we hold until maturity, we will expect to receive 8.37%. We will receive higher return if the company will not exercise its call function. Yeah. So actually, call function is not favorable for investor because they are getting less in return. Before, they can expect to receive 8.37%, but now they will only expect to receive 7%. Okay. All right. So this is the difference, yeah, between yield to maturity and yield to call. Yeah, yield to call is happen, yeah, or we calculate the yield to call when such bond are expecting to call back the debt, yeah, after a certain period of time. Okay, do you have any question, guys, in regards to yield to maturity and yield to call? Yeah, is it clear?
I think it's
Yeah. Okay, yeah. Later, I hope you guys can learn the PowerPoint slide, and I will try to upload this Excel, yeah, so that you can try at home, yeah, trying to solve this kind of exercise with different simulation, yeah. Okay. All right, so let me just continue in this 3 slides, and then we will continue the duration and immunization next class, yeah. Okay, so expected return, yeah. Expected return used by investor who expect to actively trade in and out of bonds rather than hold until maturity. So I said before that yield to maturity is an indicator of expected return, right? But that's with the assumption that you hold the bond until maturity. Yeah, you will not sell the bond. You will not sell the bond before its maturity. You'll just hold it until maturity, and you'll receive all the coupon payment and the face value at maturity. But if you decided to sell the bond, for example, after a certain period of years, yeah, you need some money, you need some cash, yeah. So you just decided to sell the bond, then there's some calculation that we have to measure our expected return, yeah. So our expected return indicates the rate of return an investor can expect to earn by holding a bond over a period of time that is less than the life of the issue. It's less than its maturity. Also called realized yield, because it shows the return an investor would realize by trading in and out of bond over short holding periods. So we called it also realized yield. It uses estimates of market price of the bond at the expected sale date instead of par value. So the calculation of expected return when we decided not to hold it until maturity, or we call this realized yield. So we're going to estimate the market price, yeah, uh, and try to make some decision based on it. Okay, so this is how they calculate the expected return on uh, equivalent realized yield. Yeah. So the bond price equal the present value of the bond annual coupon payments over the whole holding period, uh, added by the present value of the bond future price at the end of the holding period. So this is the basic formula, right? This is the basic formula in calculating the bond price. Let's try to give the example here. Yeah, find the expected return on a 7.5% bond that is currently priced, yeah, in the market at 809.5, but it's expected to rise to 960 within a 3-year holding period. Yeah. So here, wait, let me, okay. So here, yeah, uh, here is just some calculation, if we have some expected increase in the price, yeah. Let's say that it is currently priced 809, but it is expected to rise in 3 years, yeah, by 960 within the 3-year holding period. So what is the bond equivalent yield? So if we have this kind of case, then we'll just put some, some calculation on the Excel. Yeah, but remember the coupon and the period is paid on semi-annual. Yeah, so and the future value and the period is only for 3 years. So this is the bond equivalent yield or bond price after 3 years with this kind of assumptions. Yeah. And then we will try to compare it with the bond yield to maturity and see whether the equivalent yield is greater than yield to maturity. If you see that the yield to maturity is lower than the equivalent yield, you might sell this bond after 3 years. Yeah, because what's the point of holding? Yeah, what's the point of holding until maturity when it gets you only a lower yield than holding 3 years in 3 years? Yeah. Do you understand what I mean by saying this? Or should I show you the calculation?
I guess it's a little bit confusing.
Okay, let me show you with calculation, yeah.
Yes.
Okay, let's just make some assumption, yeah. Although the assumptions are not here, they just want to show you in a simple way. But let's try to make some assumption, okay? So here is said that we have a coupon paying you at how much? The coupon paying you at 7.5. So we have 75, yeah, semi-annual, semi-annual 75. So we 75 divided by 2. Yeah, 75 divided by 2. Here also 75 divided by 2. So this is the coupon, yeah, semi-annual. Okay. The face value usually 1,000 US dollar. Yeah, and here this is sell plan. So we're going to sell it at so this, yeah, so not sell plan. Okay, future value, and then we have what? Present value, the current price. Yeah, current price is 109.5. Yeah, so here also the same price. Okay, not okay. Then holding maturity, yeah, maturity here. Let's assume that it is going to mature in 15 years, while this we're going to hold it only until 3 years. Yeah. And let's assume that the expected future price for this is 960. Okay. All right. In this case, we are going to calculate the yield for both of these assumptions. But the difference between the first column and the second column is that the first column, we will not sell this bond after 3 years. We will hold this bond until maturity. Yeah. And we will receive face value at the maturity, which is 1,000 US dollar. So, yeah, we go to formula, function, yeah, financial, and then we go to rate. Here, rate. Okay. And per number of period is the maturity is 15, but wait a second, yeah, 15, because we have a semi-annual, we have to multiply it by 2. Yeah, we have to multiply by 2, and here also multiply by 2. Yeah. So the coupon payment, we have adjustment in coupon payment. We have also adjustment in maturity period, and we also have adjustment in future value. So by using this formula, we can get the go to rate, yeah, rate, where is rate? This one. All right. So the number of period is the maturity, the payment is the coupon rate, yeah. The present value is this, because it already has the negative value, so we don't need to put the negative sign here. And the future value is 1,000. Yeah. So this is the yield to maturity. The yield to maturity. And now we are what? We are planning to sell. Yeah, for example, yeah, we are planning to sell after 3 years. So we'll just put this formula and try to calculate the rate. Yeah. Now the number of period is 6 years, because we are holding it only in 3 years. The payment is 37.5. The present value is the current price. Current price in the market is this one, 809.5 with negative sign already. And the future value, you will expect that in the future, after 3 years, the price will increase only to $960. Now you click OK, and this is giving you the semi-annual yield, yeah, equivalent yield. Yeah. So, okay, so now we have two yield. This one is yield to maturity. We hold it until maturity, while this one is equivalent yield. Equivalent yield. So if you have these two options, will you hold until maturity or will you sell it after 3 years? Yeah. If I were a rational investor, I will choose to sell after 3 years because it provides me with higher yield. So in 3 years, I hold it until 3 years only. I get a profit or an expected return of 7.22%. Yeah, meaning that why should I hold until maturity and only give me 5.99% while I can sell in 3 years and I can get 7.22%. Okay, so in this case, I will try to sell the bond in 3 years because I'm expecting that the bond price will increase by $960. Yeah, and now the current price is 809. So I'll just hold it 3 years. I will receive the coupon in 3 years. Yeah, and I will receive the yield of 7.22%. Of course, this is semi-annual yield. Yeah. Okay, do you have any question? Is it clear, guys? So should you drop or should you sell your bond in 3 years or should you wait until maturity? What do you think, guys?
I'm still trying to process my thoughts right now, so I don't know.
Oh, okay. So, all right. So here, I'll just go back to the slide. Yeah. So in this case, yeah, in this case, yeah, they are trying to calculate what is the yield, what is the expected return if we decided not to hold until maturity, but we hold it only for 3 years and then we sell it in the market. Yeah. So yield to maturity is an expected return when we hold this bond until maturity. When we receive all the coupon payment, yeah, and we receive all the face value at the maturity. But what happened if we don't hold it until 15 years in this case? Yeah, but we hold it only for 3 years, and then we need some money. Let's say I have accident, or let's say things going on in life, and then I have to get some cash. I need to sell my bond, right? But I cannot hold it until maturity, until 15 years. I will only hold it until 3 years because suddenly I need some money. Yeah. So this is the things that we need to consider. If we hold it until maturity, we only get 4.99%. But if we sell it in 3 years or after 3 years, we get 7.22%, which is very high compared to the yield to maturity. So in this case, I will not hold until maturity. Why do I have to wait until maturity and it only gives me 4.99% of return? Yeah, I will just sell it and get 7.22% of return after 3 years. Okay, you get it, Mas Sultan?
Yes, I get it now. Thank you, sir.
Yeah, so this is the way to calculate whether you need to hold your bond or just sell it. Yeah, yeah, you need to, like we need to decide, yeah, whether to hold or until maturity, or we can sell it, yeah, before its maturity, and get some higher profit than holding it until maturity. Yeah. All right. So I think this is for today, guys. I will put this Excel in my ETS classroom. Well, actually, we still have one more topic to discuss, which is duration and immunization. Let me see that I will try to explain this duration and immunization concept in the next class. Hopefully, it is very easy. It is the way where we can look at the risk, yeah, of bond portfolio, yeah. We will try to look at the several bond risks, yeah, and then we choose the bond with the tolerable level of risk, yeah. And then we will learn about some bond investment strategies. So for today, I hope that you guys have learned how to find the price of the bond and how to find the yield, yeah, related to the bond, yield to maturity, yield to call, equivalent yield, and etc. And which hopefully help you for your decision whether you invest in such bond or you sell it. Okay. Uh, is there any question, any more question before I open the attendance?
Sir, I got a question.
Yeah, please.
I was wondering if you're going to upload the recording for this session,
All right.
or
Yeah, I will upload the recording. Yeah.
okay, thank you, sir.
Hmm. Okay. You can play back the recording. I will try to upload it in my YouTube. Yeah.